for FY27, we're looking at something like 17 odd percent growth in earnings per se. But mind you, this is coming off a very low base because this year will end at around 10-11% kind of growth.
Everywhere, I think the central banks, both in India domestically and in US, is trying to sort of inject liquidity essentially to support the demand.
A GDP cannot go up purely on the basis of large caps. Do not forget that even the US is not worried about their own debt. I mean, that market is moving up onto new highs every day.
Good evening, everyone, and thank you very much for taking out time this evening to join us for another session of Market Pe Charcha. It's indeed our pleasure to have you all here join us with us on this discussion. And with me, I have our CEO, Dinshaw Irani, and I am your host today, Deviprasad Nair at the India Business. For those who are joining for the first time and haven't met, so Dinshaw, quickly, let's start from the things which are happening. So we couldn't do it in between. We missed one session due to festival and then our NFOs, which was also a festival. In fact, I would like to thank our partners who supported us in making it one of the, very, very good NFO for us, where we collected close to about 480 crores net, while we collected 507 crores, but some amount we had to give it back, and then so it ended at 480 crores. Then, sure, I mean, we've been talking for this, since the Feb, and we've been, in fact, seeing that, happening in the market in terms of rate easing, liquidity infusion, and, inflation sort of, tapering. And in fact, the growth numbers also been coming. In fact, recently, yesterday we saw Fed also taking a cut and talking about, QE, quantitative easing, right? I think everywhere, I think the central banks, both in India domestically and, in US, is trying to sort of inject liquidity essentially to, support the demand, come in. But where is, this the link, which is what is the missing link, according to, where is it missing that the market is sort of not able to pick that up, or market is not reacting to that at all? And also, I would like, to take it forward in terms of our house's outlook for, the calendar year 2026, also along with this. So let's have your opinion on where is the missing link right now.
So, Devi, thank you for having me on the show, and thank you all, everybody, for joining in. And once again, as Devi said, want to thank you personally for making our small cap NFO such a big success. Thank you for the participation. And those who haven't, please do participate. That's what I want to put it as. Now, coming to the macros and micros. So normally, there's a always time lag between the fiscal and the monetary push and the actual event panning out, right? So one has seen, so what happened last year, right? Till around November of last year, we're talking about 24 now, there was no fiscal incentive being given. There was, in fact, on the monetary front, there was a lot of tightening happening. I think the RBI and the government was worried about probably inflation, runaway inflation. And obviously, they wanted to clamp down heavily on that. But what they did realize, and very early in its time, so that it was impacting demand, right? So they started infusing liquidity back in, fiscal tightening, which was happening, became fiscal loosening because you saw obviously the tax slabs being moved up, the exemption slabs being moved up. You saw the GST rationalization happening. I think that all has helped in getting demand back on, right? But normally, when you give these kind of incentives, when you put in so much of liquidity and you given so much of incentives going forward, the consumer also takes a while because he's suffered. He's suffered for the last 2 years. He is quite a bit wary of getting back in. But seeing the GST cuts, he came back in a while, right? And now the investor, who is the final link in the whole chain, he will wait it out. My feel is that there's always skepticism in the market, right? I mean, I remember when we were on the road for the NFO launch for the small cap, there was so much skepticism on the market in terms of the retail. They were worried about the Bihar elections, which happened in favor of, I mean, landslide in favor of the NDA, which ensured that there's no upheaval in the present government. Then they were worried about the US debt. I don't know why, for what reason, even the US is not worried about their own debt. I mean, that market is moving up onto new highs every day. And the third one was geopolitical tensions and stuff like that. I don't know where these come up from. My feeling was these are all excuses being used to stay away from the market. And obviously, and rightly so also because the market hasn't done much for the last couple of a year plus, right? So that may be working out, but the fact is that I don't see that remaining this way for a while. Even today, not today, even in the past few days. By the way, November was a positive number for the FIs. They were 40 million positive, in fact. Very small number for them, but they were positive. December, I feel again, after the initial sell off which is happening, I'm sure they'll come back in. There'll be a Santa rally happening, waiting to happen on the FI front also. They moved out basically because they were worried about valuations and low growth, and that has reversed. The valuations have come back in line, premiums are in line. And by the way, when I say valuations, I'm talking about the MSCI EM valuations, which are at 20 odd times forward earnings, which is way below the last 10-year averages and somewhere in line with the 15-year averages. That's how it is. Yeah. And the premiums, we are at par with what we were quoting over the last 15 years. The premiums we are there. Plus, the growth rate is coming. December was a very exciting, sorry, September was a very exciting quarter which came up. If you see the overall numbers of NSE 500, the growth rate was roughly around 15 odd percent. But then if you break it up market cap wise, the large cap growth was just 10%. The mid cap growth was 25%, and the small cap growth in earnings was 37%. So that's what is the exciting number which has come out. I'm sure the retail is waiting for some kind of a semblance. They are being born skeptics that we are in India. I think we are waiting for the conclusion of December quarter to tell us that look, things are in place, growth continues. And my feeling is December quarter will be a 16-17% kind of growth quarter. Sorry, 14-16% growth kind of growth quarter. For FY27, we're looking at something like 17 odd percent growth in earnings per se. But mind you, this is coming off a very low base because this year will end at around 10-11% kind of growth. First half was very low, and second half will be the pickup. And that's why that 10-11% growth. And FY27, we're looking at 16-17% kind of growth. So that's how the growth will pan out. Obviously, my feel is that the markets will now start reacting sometime in the March quarter. If anything, I think some semblance will come in. You'll see the FIs coming back in, participating in the rally in the market as such, and come back in. By the way, despite all the negative news, the market hasn't gone down. It's been a flattish market, yeah, which is a very healthy sign. Just shows the strength of the market per se. So when the good news comes in, that's when the real blip up happens. Having said that, you talked about what the next calendar year looks like. So this calendar year has been more or less a 10-11% kind of growth year. And frankly, I mean, that's because of the last quarter where the rally happened. Otherwise, it was a very flattish year per se. But my feel is the next year will be probably much more exciting than this year. Obviously, the growth rates will be far greater than this year because given that on a long-term basis, India normally grows at 13-14%, the catch-up has to happen. If you look at the last 3 years, India hasn't grown at all, right? In terms of calendar year basis. So that catch up has to happen, and maybe that will happen next year as such. So um, all bets are off there. I don't know how it is, but definitely we are very clear it's going to be better than this year. So basically, you're talking about a 14-15% growth on a very conservative basis, and probably you'll see some alpha generation over the index. As I said, the index is looking at some 16-17% kind of growth in earnings. If the market is slaves to that kind of growth, you'll see those kind of growths happening out. So, very clear that the worst is over and you're going to see a better uh, year going forward. So,
So, according to you, what are the structural, changes, which maybe if you would like to compare it with the previous decade or 10 years or so? What are the structural changes which are sort of supporting or, strengthening this entire, thesis, which we are sort of, talking about, that, that the forward-looking growth, which supports the forward-looking growth?
Basically, I think all of us have got carried over by what happened on the uh, exports front, right? The tariff wars, if you will, right? I think that was probably taking the focus away from domestic consumption. By the way, the uh, domestic GDP, 60% of it is driven by consumption. Even today, despite such monetary tightening and fiscal tightening by the government, the consumption continued on a very decent pace. Started contribution remained on a very decent pace, right? And looking at what happened in China, there again, they're around 60% odd contribution to GDP. So basically, the domestic consumption has to pick up. Uh, by the way, we are never very big believers on India become a China plus one play. One can see from our portfolio from the very beginning, we never had the PLI plays in our portfolio in any big way anyway. So we were not very big believers because, and I've said it very clearly on my earlier calls also, that I don't think the world today needs outsourcing. The world today is very wary of outsourcing. They're very scared of outsourcing because they saw what happened during COVID time. China could bargain whatever they could bargain with this kind of a being the manufacturing base. So the world was looking at China plus one then, but then they realized that's a temporary solution. We need a permanent solution, which is near shoring or onshoring, right? And only critical things will be manufactured in house. All the other lateral things which can be easily substituted can be given off outside. And that's what is implied by the margins of the outsourcing companies that India has. Single digits, low single digit margins is what we command today, which is not too healthy, right? So we are never true believers in this. I think the big belief is derived from the fact that India will internally grow its earnings, internally will grow its GDP by way of consumption. Exports can be a cherry on the cake, but if consumption kicks in, we have no doubt. In fact, if you see our portfolio, it's bulk of it is consumption, and by the derived consumption also, because BFSI, which is banking, financial services, and insurance, it's a derivative of consumption. These are the ones which are going to fuel the consumption as such, so if you will. And that's why if you combine the two together, pure consumption, derived consumption, and BFSI, roughly around 70-80% of our portfolio is that, and we'll continue to remain heavy there. So that way. And if you ask me why we are, I'm sure the next question is going to be that why we are so convinced that India will be a consumption story going forward. Uh, well, I'll just briefly touch upon this also because it's fairly close to my heart. So if you see the labor pool, ultimately the labor pool is what drives consumption, right? You earn and you spend. Yeah, that's what the consumption is all about. So if you look at the labor pool today, roughly around 29% odd consists of uh, pre-millennial labor. Pre-millennial means those born before the 80s, right? And I'm a part of that, by the way. And why I'm segregating that out is because that particular pool was a very conservative pool. I mean, if I had gone to my dad and said, "Look, I have got my salary, first salary. I'm gonna, leverage my salary and go and buy a bike," I would have got one tight slap from my dad saying that, "Look, beta, you got to supposed to save. You're not supposed to spend. Your bike will come later. After 10 years, you can own a bike, but today you save, right?" So that's how the thing was. In fact, we were brought up on staple dialogues like. पाँव उतना ही पसारो जितनी चादर लंबी हो बेसिकली डोंट स्पेंड बियॉन्ड योर मीन्स और बूंद बूंद से घड़ा भरता है सो एवरी ड्रॉप मैटर्स सो यू सेव एवरी सिंगल penny that you earn and stuff like that. Don't spend. That was the whole thing, right? And the economy like India, growing economy like India, needs spenders. They need people to lever their money. They need that velocity of money to kick in because how much can you print for that money to go out, right? So you need that velocity. And thankfully, with our UPIs and stuff like that, online payment systems, I think we've cracked the big game out here. Coming to, okay, so pre-millennials I've talked about, why they were so conservative. Now let's talk about the millennials. Millennials are roughly around, I would say around 33 odd percent of the whole the labor pool, and the rest, fortunately, are the Generation Z, the Gen Z, the ones which were born after 90s as such. Yeah. So basically, this pool is the one where I'm very kicked about. This is the pool which is rather the millennials and the Gen Zs. This is where they know how to spend. They know how to live life. I have two mid 20s to late 20 kids in my house, and they already are talking about work life balance and stuff like that, which at that age when I was working, there was nothing like a work life balance. It was always work, 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 earn, save, and stuff like that. These guys are like, the moment they save something, they go on a vacation. And that's what I think India needs today. They need people like these to go and spend and to enjoy life, right? And this is what gives you that consumption boom. If you guys remember China, I don't know how many of you do, but China did only that much when it became a outsourcing base for the world, right? By 2005, China's per capita GDP was more or less similar to what India's is today, around 26, $2,700. But then the consumption kicked in a big way, and you saw 2007, two years later, the GDP was $3,800 per capita. That was mainly because of the way the consumption happened and added to the earnings of all the GDP as such, added to the GDP as such. Just to end this argument, there was this stand-up comedian whom I heard one day, and that typically reflects the thinking of Generation Z. So he said that, I got my first salary, and I went up to my dad and said, Dad, I'm going to use this salary. I'm going to the bank, and I'm going to show them my pay slip, and I'm going to borrow money and buy a bullet. So the father told him, I was scared, so that's why the bullet, right? So the father told him, Beta, don't do this. Go and open a FD instead. He says, Dad, I will not be able to date someone and make her sit on my FD and take her, right? So this is the thinking this generation has. I love it. I love it. I love. And by the way, one more thing, with this generation coming in, with this kind of a generation moving in, imagine what all changes they brought, right? Formalization has become a way of life. There's no informal sector. They like brands, they love brands. Uh, Even a brand which advertises on TV is supposed to be a good brand. So they have that relationship to brands. They will never go and buy loose atta, loose dal, and stuff like that. It's all getting formalized. That formalization itself is a big kicker for the economy, right? And when you get educated, and this by the way group is a very well educated group. They all, minimum is they need to pass the schooling, right? That's a minimum that they're looking at. So this group, uh, with so many women participation, has, and by the way, women participation is a very uh, big, I would say, positive for the economy itself, because when you do that, when women participation in the labor pool increases, they are normally the ones which run the house, right? We men are supposed to earn and forget about whatever happens with money, right? The women are the ones which really know where to spend and what to spend. Once they get into that labor pool, they ensure that there's a price quality relationship which comes in, right? They do not look for bargains. We guys are idiots. I mean, we see a discount and say, okay, we'll buy this, it's a discount. But the woman really knows how to spend her money, and she makes sure that she buys banded stuffs and stuff like that. So this is a major chain which is undertaken, Devi, and it's going to be very difficult for this chain to get rattled going forward. Unless some major event happens, I don't see us backing off now. I think our day in the sun has come. I think we are on a very good cusp here. Probably we are where China was in the mid 2010s in terms of growth as such.
Now it's been sliding, and in fact, we all know, and while that we've been holding it on for some time, right? But what do you think, and where do you think it's gonna end? Because at some point of time, it becomes a real worry, because of FII flows. Even if the liquidity glut goes up in US, I think the sliding rupee would sort of curtail that sentiment, positive sentiment, which will bring in money to India. So where do you think, it's moving directionally? What is our view on that from a near-term basis?
So, okay, depreciating rupee is in fact, I think that's a very good ploy on the part of the government. They made a concerted effort to do it. I think they basically, obviously, Such a big fall wasn't expected. But having said that, I think that's a way of curbing the tariff war, right? So you apply a tariff, you fight the tariff purely by depreciating currency. China did that for a very long time. China did that for a very, very long time. After which they became too big to do this. But I think India's worked that perfectly, right? 10% depreciation. So you offset that duty of 25%, if there was a 25% duty. I'm hoping that that duty will reverse, by the way. The penal duty of 25% will reverse and will remain at 25. So when you depreciate your currency by 10%, your effective duty is only 15%, right? So that's what they've tried to do out here. Having said that, even as a destination, India becomes attractive because when you bring in your dollars, you get in more rupees, right? But if you are appreciating, then when you move out your dollars, you get less rupees, right? So this is, I think, a very good ploy to even attract money. And I've come across quite a few FIs who are looking at India at a very, I would say, benign way, because they believe that Indian currency is the only currency which has depreciated today. If you look at any other global currency, they've appreciated against the dollar. India is the only one which has depreciated so sharply against the USD, right? So that's what makes it attractive. So I don't see that as a negative. I think in fact that's a positive. I think the FIs were out because they wanted to see growth. We had, after September, which was a negative quarter, we had 3 quarters of flattish growth, right? Now, obviously, 4 quarters of such redundant growth. By the way, September this year also, I think someone can take it with a pinch of salt, because September this year growth, which I mentioned earlier, was on the back of a very low base. So one can always argue that there was a low base, that's why you guys are showing this kind of growth. But going forward, there's no excuses, right? We have 3 flattish quarters on which the growth will come in. And that's what I believe, that they're waiting for some kind of a semblance before taking a call. We are FPIs, right? We also have FPI licenses. We, as in our parent, has FPI licenses outside in Singapore. And they're seeing a lot of flows happening. They're seeing a lot of inflows happening as such. So I have no doubt that we are the only ones who are seeing this. I'm sure there are others also seeing this. Obviously, the deployment will be very selective. And the good part is that instead of buying ETFs, this time around the FIs have chosen to come to active managers who are ready to invest the money in across market caps as such. So I have no doubt in my mind, Devi, that probably even by the end of December, you'll see some flows happening, positive flows happening on the FI front. And going into the next quarter, you'll see good amount of flows coming back in as such. By the way, I came across a very interesting number uh, today, that the overall selling by FIs has been $24.5 billion in India year to date. Yeah. But in the primary market, this is the secondary market, but in the primary market, they bought $9.5 billion. So actually, it's not 24.5 billion of selling, it's actually 15 billion of selling net, which is nothing. I mean, our DIs are about $60 billion worth as such. So there's only an offset happening out here. So I don't see this to be a problem, but I see this to be turning positive going forward. So
You talked about the FIIs coming back, but which pocket? I mean, there is one part of the industry where people are saying that large cap is the place to be in, while we've been clearly, in fact, we have demonstrated also. We've been on the for some time saying that look, small and mid caps look attractive on a 1 year forward basis, and that's why we doing this. So what's your outlook for small and mid cap, from here? I mean, where do you see it moving?
So, okay, just to refresh memories, we had received our mid-cap fund approval sometime in August of last year. But we never launched it then, and we launched it only in Feb of this year. Basically, because we felt that, okay, now is the time to go ahead and launch uh, our system, because our fund, because as I said, that we have this elimination investment angle that we look at, and that pool decides what is looking attractive and what is not. And by then, we had a lot of mid caps and small caps which were coming into that pool, and that's what excited us, and that's why we launched it. And one has seen the performance. I don't even want to talk about it. It's been a very good performance. I'm very happy with the performance. Same was the case with our small cap. We received the approval quite a while back, but finally we launched it in November because we felt that this is a time to look at small caps. I think the kind of underperformance that the small caps have seen, small and mid caps rather, over the last 5 years is a historic underperformance. Large caps, on the other hand, haven't seen a good performance either, but they've been flattish to an extent, right? So that underperformance vis-a-vis the large cap was fairly elaborated as such. And maybe there was some justification because the earnings growth were negative, right? But from here on, we're seeing positive earnings growth happening. And mind you, a GDP cannot go up purely on the basis of large caps. Do not forget that even in the US, the SMEs, MSMEs rather, they drive 65% of their economy out there in the US. India is no different. I think if anything, India may be slightly higher than 65% as such. So two-thirds roughly economy being driven by MSMEs. Obviously, when the economy grows, these guys will be good participants, and you'll see a healthy growth happening. You'll see a lot of new listings coming through as such, and very exciting names coming through. Most of you have seen our portfolio now, I'm sure, of the small cap. You've seen very exciting names out there, and I'm very excited about that portfolio. I think you'll see some kind of a trickle happening from that portfolio into even my flexi cap fund as such, because that's how excited my managers are looking at the numbers as such. So that when, mind you, whenever we start a new fund, the analysts go into our analysts go into an overdrive to identify newer stocks and all, and they also feel pretty enthralled by what they've discovered and stuff like that. So that's what's happening out here, and I have no doubts that it's a matter of time before the mid and small start participating in a big way. Even now, if you've noticed, whenever the market rallies, these two pockets run up the most, right? I think it's basically oversold territory which is now picking up, and I see it as a structural thing. I don't see it as a small blip right now. I think it's going to be a healthy run going forward. So that will.
I would request the participants to, type in their questions in the webinar chat section. I will be taking up the questions, few questions from here on. So the participants' question is that, what is our take on that? What's our take on the IMF downgrading the data quality? I think it was something related to the inflation data and projections, which IMF had come. And in fact, I think Finance Ministry also gave a clarification on that. So do you have any comments on that?
So basically, see, the point is that everybody, I mean, I'm emerging economy, right? And I'm sure there are these concerted interests which try to pull you down going forward, right? Let's not forget IMF is controlled mainly by the American money coming in.
Yeah.
I'm not intuiting anything, but I think uh, if anything, those guys cannot point fingers at us. Their data is much more worse than ours is. I would take, if anything, I would take my data as pristine as such, and I will stick to that. I will not. By the way, since you mentioned IMF, uh, that same organization upgraded our numbers after seeing the first quarter GDP growth. They upgraded our overall full year GDP growth. But smartly, what they did was they cut off their own projections for every quarter of our next 3 quarters of GDP, right? So they cut off the say 2Q GDP. After the second quarter GDP numbers, which came out, which are mind blowing, they again upgraded their numbers marginally, but cut off the numbers for the third and fourth quarter of GDP. So I don't know how much to trust those guys than to trust our own selves. I would rather trust our own numbers as such. And we can keep arguing. As I said, our Indian investors are very skeptical about our own future as such. And that's why they like American story rather than an Indian story. I would rather not look at that way. I think we are on a very even ground, and I'll stick to that right now on this one. So
The geopolitics, the way it is panning out, we've been seeing sort of a cold, war kind of a thing between, in fact, even India has indulged into it, India, US, Russia, China, right? And what do you see? I mean, it impacting, how do you see that impacting our markets? Do you see a major impact coming because of, while, for from 22 onwards, due to the war and all that, market hasn't given up. right? But somewhere I think there is a discomfort. Which do you see that there is a discomfort building between investors in terms of the geopolitical environment panning out?
So yeah, that's one of the reasons that I heard about geopolitical tensions being run out. And by the way, just to again a very glaring data point, if the Ukraine and Russia war continues till June next year, this will be the longest war ever in the history of mankind. The World War II will be left behind in terms of that. So why I'm telling you this is that we've seen this. We've seen this. We've survived this. So I don't see any bigger issue out here. Geopolitical tension can only be aggravated if India gets involved in this whole story, right? Which I don't see happening. I don't think India needs, they are looking at economic growth. Obviously, whenever we are provoked, we go and teach a very telling lesson to the neighbor who's trying to provoke us. But apart from that, I don't think we want a long term, long drawn war with anybody as such. And yeah, if we can avoid that, that'll be perfect. That's how it is. There's one question on the site which is saying that India is an importing country. We are poor in exporting, very poor in exporting. Okay, so the fact is, what do we import? We import mainly crude. That is the biggest component of imports for India. And fortunately, as I said, that the rupee depreciation may not have that much impact because crude has behaved itself a lot, right? The bigger hit that we get is of households importing gold. We don't produce our own gold, so we import. I think that is where the big problem arises. For some reason, we are fascinated with gold and silver as such. In fact, someone had asked me a question also about what I see as gold and silver and all that. I have no view out here because I've given up on precious metals per se. I don't know how they go up so much because ultimately they don't earn anything. It's just pure fascination and pure. I think the the gambling thought which makes them drive up so that way. So don't get worried too much with these kind of stories. I think if we can control our gold imports, we are home and dry. We won't have a problem on that front per se.
There are these
So there's
new
one more
drugs,
question
Dinshaw. Yeah.
on valuation also, Devi,
Yes.
which is for mid and small caps. Someone has asked, is it overvalued or no? So basically, the fact is that when you look at standalone valuations, you'll worry, right? But uh, the example that I give is suppose I give you two companies, both quoting at P's of 20 times forward earnings, right? But then I tell you that, say, A company, 20 time forward earnings for growth rates of, say, 20%. And the other B company, which is quoting at 20 times forward P's at growth rates of, say, 5%. Which one will you buy? It's a no-brainer, right? You'll go and buy A because it's got 20% growth and 20 times PE, while the other one is at 20% growth but 5%, sorry, 20 times PE but 5% growth. So the peg for that is 4 and the peg for this is 1. So you cannot talk about earnings standalone. So let me give you my thoughts on this one. So basically, if you look at the large cap universe, it quotes at roughly around 18, 19 times forward earnings, right? But the growth rate there is 12%. So now the peg 19 divided by 12 is roughly around 1.7 or so, right? Now go to the mid cap universe. The P there is 32%, but the growth rate there is some 22, 23%. So now the peg, the PE divided by the earnings growth is 1.5. So that 1.7 now becomes more expensive than 1.5. The large cap is looking more expensive. Come to the small cap universe. The P there is some 25 times forward earnings or something. And the growth rate there is 23%. So now the peg is 1.1, right? So now this is the most cheapest. So let's not talk about PE, standalone PEs and say that they're overvalued. I think there's a perfect place for everybody given the growth rates. I think these are the sectors which are looking, these are two components which are looking much more exciting as such. So that way.
There are other
Okay, IT
questions which
pharma, you're talking about GLP?
yeah, pharma, yeah, GLP-1, yes.
Okay, so basically now look at it this way that I remember starting to cover pharma way back in 2000 is when I started covering pharma. And I used to go and pitch these ideas to all the US clients and all. And the pushback I used to get always was that you guys are pirates. You go on the patented products and you pirate them and you sell them and stuff like that, right? We don't. We actually don't. We are actually following protocols. We wait for the patent expiry to happen before doing it. Same is the case with GLP, right? Now, the GLP story is too early in the day uh, to even call it out. My feel is uh, I don't know what the back lash will be once it becomes an aged drug. In fact, in Australia, I came across a data point that around 3 lakh consumers out there have been suffering from of these GLP-1 drugs, have been suffering from depression and suicidal thoughts and stuff like that. I don't know whether that's true or no. I just came across the data point and I was wondering what all can happen going forward. If you dig into the net and you look at the after effects, the side effects of these long-term users, which are like 1 year and 2 year of users, you'll see that there are a lot of side effects happening out here. So I don't know how this will pan out. I mean, ideally, everyone should be taking a GLP, right? Given the kind of weight loss that one comes through. But looking at the side effects, I think the doctors also vary. So I won't bet too much on this. Obviously, IT, you know our views. We are very negative. We remain negative. We don't see any positives out here till there's a reset happening in IT. And pharma also, now, come on. I mean, most of our income comes from US, right? That's where the excitement part is. We are not excited about that. We think that domestic is the way you want to play it, and this is where you want to be. So that way. So we'll stick with that.
I think somebody is asking GLP. It's like glucalide like peptide, right? That's
No,
GLP
no,
is it's
Mounjaro,
basically
semiglutide,
yeah. It's like it's a drug to control the sugar
weight
levels in your
loss.
blood. It GLP hormone actually, right,
So
Dinshaw?
basically, yeah. So basically it's a derivative of
Yes,
a drug which was produced for
diabetes.
diabetes.
Yeah.
Now, what they noticed was when you take that drug, you lose weight, right? Because it cuts your appetite. But that was for diabetes. Now you're trying to target weight loss with this drug. That's a total, needs a different set of way of looking at things. So that way.
So there are questions on IT, your view on IT, and we still haven't entered into IT. So that's one thing. But there is one question which I would like to specifically answer. It had come in very beginning that why did we invest everything in small cap? Well, I'll just hand it over to Dinshaw in a minute. But if you remember, we started mid cap, and in between, when we started, there was a tad bit of underperformance because at that point of time the markets were falling and we were cautious. We didn't deploy, and then market already started moving up. Right, this time we again raised the money and we deployed, but again the market is falling. So while Dinshaw will obviously take it forward, but nobody knows that when the markets will start moving up. So it's always when the mandate is of deploying money, we have to go and deploy. That's what it. And another worry which I keep getting from IFAs and our distribution partner in terms of why did you deploy. But the thing is that we get everyday cash flows coming into small cap because we didn't raise money and close the fund. We've been getting everyday money. In fact, the 480 crores has now become 540 crores, right? So that kind of flows we have got. So it's sort of a myth to hold back this thing that you shouldn't deploy money, you should be cautious because you don't know if the market moves, and if you're sitting with pile of cash, I think it is detrimental for the NAV also. And on the other side, you keep getting everyday cash. So Dinshaw, you have your view. You can share on uh, that your view
So
also.
basically, yeah. So basically, we were very clear that look, there are a lot of value in the small cap space, and when we get the money, we'll deploy. So if I got I think the last date of collection was 20th November, Devi, am I right? Yeah. And we started deploying from 21st onwards. We didn't have any problem with that because we know that there'll be flows happening now and then, and we'll keep averaging as and when. By the way, if you guys remember our mid cap also, as Devi rightly pointed out, the initial week or so, it was quite choppy, right? We went below 10 and stuff like that. And after that, you've seen the way it's gone up per se. I have no doubt. I'm not saying that this is what's going to happen, but looking at the composition of the portfolio, and you all must have seen it, you all must have seen the kind of unique names that we got in the portfolio. I don't see a problem deploying money even when I get it today. So I have no doubts that this is a time when you want to consolidate your portfolio and you want to work ahead as such. So that way, so we'll keep deploying the money that we get. Even today, I think we have around 2-3% of cash lying in the
Yeah.
portfolio. We are not we're not going to hold back any cash as such. So that way. And there's one more question on micro caps, right? Mutual funds can't buy. There's no sanctity in that answer. I mean, there's no sorry, that question, because mutual funds can buy. If you see my portfolio, we have around 20% in invested in micro caps, right?
Yeah.
So that's what we got there. So by the way, they're classified as small caps only. SEBI has
Yes.
given it very clearly that you can have small caps and micro caps as clubbed as your small cap and consisting of 65% of the portfolio when you look at a portfolio as such. So we
And
have that.
we did talk about it, when we were doing our roadshows also, that we will have, some bit of that in the portfolio. A couple of last questions, Dinshaw, since we are entering to 2026, large, mid, and small, which one do you see winning the race at the end of 2026 calendar year? Where do you bet your money?
My heart lies in my mid cap and small cap. I mean, if you see in our flows, this is what we are looking at. So basically, my feel is, Devi, that when the collapse as in the earnings collapse happened, it was very pronounced in mid and small caps. The large caps didn't fall that much, right? Because they're less levered, they have clean balance sheets. I mean, other strong balance sheets and stuff like that. It was the mid and small which had a hit, right? Here on, when the growth kicks in, as I said, that
Yeah.
MSMEs have to participate in a big way. And that's why I think that this is what's going to happen here as such. So I think the mid and small will be the one where the run up will be faster than what you'll see in the large cap. You can always track my flexi cap to see where our heart lies today, right? Today it's 50-50 large caps and roughly 50% mid and small.
Yeah, 24. Yeah.
Yeah, so that mix will decide where we believe our faith is lying. Even in my large and mid cap, it's 50-50 today. But if you see my mid cap, it's 100% mid and small caps. Hardly, I think, only one large cap in that portfolio. And then go to my small cap, it's all small and mid cap. There's not a single large cap there. So that way. So I think I'll go with that rather than anything else as such.
Another question is, which are the top three or four sectors which will win the race in 2026?
So I have no doubt that obviously BFSI will be one of the leaders going forward, because as I said, that when consumption picks up, you need to have these derivatives in place which are going to drive consumption, right? So that's why I believe that BFSI is one big winner, obviously followed by consumption, and not FMCG, by the way. It'll be mainly discretionary which will come through. And the third sector that, by the way, consumption, when I say, I have a lot of things clubbed together in consumption: hotels, then I have hospitality, I have hospitals,
Yeah.
aviation. All these guys are clubbed in together as such, jewelry and stuff like that. Yeah, that's all goes in, right? And the third sector that we believe will be very exponentially growing forward is obviously the infra play, the capex play. That is the one sector that we're looking at, because when you have this consumption boom, you have to have a capex related capex boom also, and those who capitalize on that boom are the ones which will win out as such. So, by the way, there's one question on AI by asking whether China and Korea are preferred because of their AI and manufacturing strength. I would say that it's the other way around. The world is now worried about AI. I told you about a big client that was looking at us to invest in AI. They've already shortlisted and they've started investing through us. Their major concern was this, that look, AI is becoming a bubble, not a bubble, but it's becoming a very expensive play to play with. Yeah. And in the US, it's the market is mainly driven by AI. So they're worried about that. And that's why they are looking at India, because India is the only, by the way, the emerging market index, MSCI EM, there are four major markets in that, which account for roughly around 70% of that index: China, Korea, South Korea, Taiwan, and India. These are the four markets, right? India, out of these four, is the only one which has got no AI bets playing out. Korea, Taiwan, both very this thing AI heavy, right? China, to a great extent, AI heavy, right? Because obviously, as I said, that if you guys remember, when DeepSeek came out, that's when China started rallying, because there was all AI money moving in. So India is the only one which is a non-AI bet as such. Having said that, I think India, it's it's an advantage today of not being so dependent on AI. By the way, AI will probably be what do you call G1 syndrome, where as the commodity is under demand, the price of the commodity corrects rather than moves up because you'll see newer and newer introduction happening out here. So that way. And one more question about the same person has asked me about is the yen carry trade. Obviously, the yen carry trade was working on the fact that the yen will always be very cheaply available. You borrow in the yen and you deploy it in other currencies which are earning higher, right? Like, so you borrow 0.5% in yen at a 0.5% rate in yen and deploy it in US treasuries, which were at 0.75% or 4% and stuff like that, and you earn money. I think Japan has done the right thing by not being so, basically, they're being aggressive on growth for their own. So I don't think this yen carry is going to be a big problem going forward, but globally the interest rates are falling as such. So that yen carry trade was anyway going to die out at some stage in time. So that way, maybe it'll bring out an earlier death, but it'll be a very structured way because yen is not strengthening. It is, in fact, if anything, it's remaining at that levels as such, which are easier for you to reverse. The reversal becomes a problem if the yen strengthens, which is not happening here. So, and given that even Japan is talking about moving away from that tight interest rate scenario, I think it's going to work out perfectly for the world. So don't panic on the yen bit per se.
So there is one question on the overlap between small and mid cap.
20% is
20%.
the mid cap, which
Yeah,
is replicated
20%.
in my small cap plant.
Yes.
Plus, I think there'll be around 20-25% more,
Yeah, not
which will
more,
be
not
the
more.
small cap, which will be. So 45 odd percent would be your overlap as such. So
Thank you very much for joining us. Have a Merry Christmas and a great New Year. We will see you around on the other side of life in 2026, sometime in January. Till then, stay safe. Dinshaw, your message to our partners for New Year.
yeah, please have a
We will
very
end with that.
lovely Yuletide season. Enjoy the holidays and come back charged. And please tell your investors to come back heavy in the markets again. So that way.
Thanks, Dinshaw. Thanks, partners. And thank you, everyone, for joining us. Have a great evening. Thanks. Bye.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.